Welcome to the Essential Guide to IAS 19, the international accounting standard that governs how companies account for all forms of compensation provided to their employees. Its core objective is simple: when an employee provides service, the entity must recognize a liability for the future payment and an expense for the service consumed. IAS 19 organizes employee benefits into 4 key categories. Let's break them down. First, we have short-term employee benefits. These are payments due to be settled entirely within 12 months, such as wages, salaries, and paid annual leave. Accounting for these is straightforward. They are recognized at their undiscounted amount as the service is rendered. Second, other long-term benefits. These include things like long service leave or long-term disability. Their measurement is more complex, similar to post-employment plans, but all actuarial gains and losses are recognized immediately in profit or loss. Third, termination benefits. These are paid when employment ends, either by the entity or by the employee accepting an offer of termination. The key recognition point is the earlier of when the entity can no longer withdraw the offer, or when it recognizes costs for a related restructuring. And finally, the most critical category, post-employment benefits. This is where we account for pensions and post-employment medical care. These plans are classified into one of 2 types. Type 1, defined contribution plans. The entity pays fixed contributions into a fund and has no further obligation if the fund is insufficient. The risk falls on the employee. Accounting is simple: the contribution payable is the expense for the period. Type 2, defined benefit plans. Here, the entity is obliged to provide a predetermined level of benefit, like a percentage of final salary. This means the entity bears the actuarial and investment risk. Accounting for a defined benefit plan is complex, requiring an actuary to estimate future costs using the projected unit credit method. The final figure on the balance sheet, the net defined benefit liability, or asset, is the difference between the present value of the defined benefit obligation and the fair value of plan assets. The changes in this net liability are split into 2 places on the financial statements. 1. Profit or loss, P&L. This is where you recognize the service cost for employee services provided in the current period, plus the net interest on the net liability or asset. 2. Other comprehensive income, OCI. This is a key requirement. Remeasurements are recognized here. Remeasurements capture the unexpected, actuarial gains and losses from changes in assumptions, and the actual return on plan assets less the net interest recognized in P&L. Crucially, these amounts are not reclassified to P&L later. To make all this work, companies must use unbiased and compatible actuarial assumptions, including the discount rate, which is set by referencing high-quality corporate bonds. In summary, IAS 19 ensures that a company's financial statements accurately reflect the true economic commitment it has made to its workforce, moving beyond simple cash contributions to capture future obligations. If you're dealing with pensions, long service benefits, or complex severance, IAS 19 is your guide to fair and accurate reporting. Thank you for watching.